All right, everyone. So here we are, Chapter 7, the Gap and Go strategy. So you finally made it. You made it through the starter. You made it through the first 6 chapters of the pro. And this is where we get into the meat of the strategy. Now, I know everyone wants to jump into strategy first. If you're watching this in the LMS and you skipped all the other classes to jump in here, I will tell you that there is no doubt you're going to be missing a lot of the groundwork that we have already laid in all of those chapters, which at this point now is, let's see, 15 plus 6, so 21 chapters of content. So those 21 chapters, those were all laying the foundation in all their different components, from order entry, routing, hotkeys, dark pools, all the things that we just talked about in the last chapter, and then all the way going back to risk management and what constitutes a strong stock, daily charts, gaps, windows, ascending, descending, support, resistance lines. It all comes together right here with the gap and go strategy. The gap and go strategy, this actually is one of my favorite strategies. And although in the last year I've started taking more and more trades pre-market, because the market has just seen so much volatility, I think the reason we've seen that volatility at the open and then sort of becoming more pre-market is because of how well the gap and go strategy works. Stocks that often gap up go higher, and because of that pattern, traders start saying, I'm not waiting till the bell rings, I'm going to buy it pre-market. So a gap and go now includes sometimes pre-market trades. They're not just exclusive to, the bell rings at 9:30 and we start trading. Although we can certainly do that, we can also trade these pre-market. So this is a form of momentum trading. I am a momentum trader. I'm a technical trader. And in recent weeks with the big move on GameStop, there was definitely some criticism out there by some of the, pundits on the financial news networks and stuff like that of traders just, calling us barbarians and barbarians at the gate and an army of novice traders, because we're just buying up this stock as it was going higher and higher and higher. But in fact, momentum trading is something that firms, including large hedge funds, have been doing for a very long time. This isn't an amateur strategy. This is a strategy that a lot of beginner traders may adopt, but it's also used by a lot of big funds. I read about a hedge fund that made $730 million long on GME. Yeah, they bought it. They rode that momentum. So, of course, there's some hedge funds that lost on it, as we know, but there's others that said, hey, this is volatility. This is a short squeeze. We're jumping on 100 million shares. Let's go. Whatever it is. I mean, not 100 million in this case because the float was not even that high. But you know what I mean. Like, jumping on the momentum and see where it goes. Okay, girl. Bye-bye. So, momentum trading, a momentum stock is a stock experiencing a strong trend. As day traders, we focus on the intraday chart, and primarily on the 5-minute chart, certainly as the basis of the strongest patterns, but also no doubt on the 1 minute. And we don't forget about the daily, but the intraday charts are important. Momentum typically ends when the stock reverses directions and begins to break below its moving averages. So we can usually differentiate and look at a stock as when it's kind of on the sort of front side of that move up and when the tide is shifted. And in this case, we could say pretty clearly it was on this day right here. Now, while it's true that on this day here, with that huge red topping tail, that it did end up, as you can see, gapping higher the next day, it was a red candle, and that was just sort of the top of this particular stock. But we could look at this on any number of stocks, both on daily charts like this, where this was the top, and also on intraday charts like this AUVI, where clearly we had a top on this right up here at 30, and it's now sort of on the backside. Now again, it doesn't mean it can't potentially rally back up, but realistically the front side of momentum is where we want to be focusing. So that would be trading in these areas here and here, and kind of stepping back off of the stock during these little sort of ebb periods. So again, if we think about that analogy of the tide rolling in, as it's rolling in, sometimes, we'll get a nice wave up and then a little bit of a pullback, and then a nice wave further up and then another pullback. And we don't always know for sure when we've already hit the top and now we're rolling back. So as we're experiencing those little pullbacks, we're looking very closely at the tape and the candlesticks and trying to ask ourselves, what are these candlesticks telling us? Is this a big long body candle? Is it a topping tail doji? Is this candle giving me reasons to be very cautious? But technical trading and momentum trading is a very popular strategy. It has been really since the beginning of the market. You look back at the Roaring 20s, and momentum trading. That was the strategy. It was buy what's moving up, buy high, sell higher. So that's what we do as momentum traders. So I'm a momentum trader occasionally, and I will teach you about some reversal strategies, which is called counter trend trading. It's when something is very, very strong, you're trying to short it, or something is very, very weak and you're trying to buy it. But I've almost always found that it's much harder to predict that reversal point than to just jump on, you jump out in a river and you're going to float downstream. And that's like getting on a stock that has momentum. You get in, it's already moving, you just have to hold on. That's all. Yeah, sure, there's maybe going to be some bumps. I mean, it's not that simple. But you get the idea that it's much easier to do that than to swim against the trend of the current of trying to predict the reversal. Because oftentimes reversals can be very, very sharp. They're so quick that then if you didn't get it exactly right, well, now you're chasing it. And it's tough. So momentum trading for me has always made a lot more sense. So today you'll learn about my favorite day trading strategies. They are based on momentum, and the gap and go strategy is, for me, one of the best. So this means finding stocks that are running, which is another expression for moving up quickly, former runner, moving up fast, and buying them with the expectation that they will go higher. Now, the inverse would be true if you were shorting a weak stock that's selling off, but of course we won't talk about that quite as much. Remember that today we are now developing strategies. We're combining everything we've already learned so far. A strategy combines the right type of stock to trade, specific types of chart patterns, specific times of day, a predetermined level of risk, certainly an understanding of the more complex components of the market, including routing, hotkeys, level 2, reading the tape. A strategy is a unified approach for how you're going to trade the markets. And in order to be successful, a strategy has to be followed to a T. This is the biggest challenge for beginner traders. I'm going to lay out the entire strategy for you. And then you will see on some days, Ross, you're not even following the rules of your own strategy. And you'd be right. There are some days where even me with all these years of experience fall victim to the emotional traps in the market. And I fall into them. And I find myself emotionally hijacked, extremely frustrated, angry, revenge trading starts to come out, FOMO starts to come out, and that's the time where no doubt you have to step back. But you will all probably at some point or another have a moment of feeling emotionally hijacked, and I still have those moments. It's not learning level 2. Once you learn it, you know it. Learning to ride a bike, once you learn it, you have it. Just learning about the emotional hijack doesn't stop it from happening. I was watching The Sopranos last night, and just as funny, and the Tony's driver, this guy cuts him off, and he's, hey, yo, and now you know why I was using Anthony as my hedge fund guy. So he's like, hey, yo, nice work using your blinker, or something like that, and the guy's like, hey, why don't you shut the hell up? And he's like, and he, pulls off his seatbelt, and he opens the door, and Tony's like, hey, easy, and he's like, I know, Tony. My mother tells me to take a breath, but I always forget. And I was like, I thought it was so funny because that's me, in the sense of my trading. My mother tells me to take a breath, and I know I should take a breath, but then here I go again, and sometimes you need that person to grab you by the shoulder and say, dude, snap out of it. What's going on? And so I think certainly part of this class, as we continue with, we get through the strategies and we get into some of the more, we bring back trader psychology, and we talk with some of our students who have become successful traders. We'll be talking about some of the tips and tricks that some of us have learned to help us keep a lid on some of these emotions, which, we do the best we can, but we all at times will struggle with it. So just be mindful of that. But again, so to reiterate, right now, I'm putting the roadmap in front of you, but it will be your job to follow that roadmap to prove that you can profitably trade it in a simulator. And then once you have some confidence trading in the simulator, at that point, consider, girl, you got snow on you. Consider flipping the switch and trading with real money. All right, girl. Okay. So why is this important? Well, this is the basis of my strategy. And so therefore, the most important concepts that you're here to learn. again, not to diminish the importance of building the foundation, but this is the house that's on top of it. So in my opinion, this is just my opinion, and it's not a guarantee of any type, but in my opinion, this is the easiest strategy to use to build a small account. This is the strategy that I have used several times in a row to build a small account. So this is the gap and go strategy. Now, as I mentioned, or I mentioned this maybe before I started the recording, but this is a long chapter, and this chapter is broken into several sub-parts. So, for instance, this is part 7 on pre-market gap and go trades. So each individual setup will be its own separate mini lesson within this chapter. So you'll be able to go back for a refresher if you want. And it also gives me the opportunity, if I end up developing a 8th or 9th or 10th gap and go strategy, that I can just tuck that in within this class, and it's easy to add. But this is the general outline. So the time frame is 9:30 to 9:45, really. That's the gap and go period. Now, this is originally the gap and go period was 9:30 to 9:45. And in those days, in some of the older examples that I show you, we'll see a stock at 9:30 that still only has a couple 100,000 shares of volume. Whereas today, pre-market, I mean, I think there were several stocks, maybe 5 or more, that had more than 15 million shares of volume pre-market. So we have noticed this pattern of trading starting earlier and earlier in the day. So we will sometimes allow for pre-market trading, which, well, pre-market starts at 4 a.m. While it's true that for the first time in my career, 2 weeks ago, I did get up at 4 a.m. to trade GameStop. That's not, I don't plan that that's going to be a habit for me. I do not like getting up at 3:45 to trade in the morning. But trading between maybe 7 or 8 and 9:30 can be okay. It does seem that around 7 a.m. things start to pick up. Brokers like TD Ameritrade and I believe Robinhood don't allow pre-market trading before 7 a.m. So sometimes we'll notice as more brokers are coming online that starting at around 7 a.m. we'll see more volume. So, 7 a.m., it is early, and there's some days where you'll sit down at 7 a.m. and there's nothing happening. And then you're like, well, now I just have to sit here for 2 hours. I'm already ready to go. So if you really want to sit down and have a pretty good level of conviction that there'll be something to trade, sitting down at 8 or 8:30 is probably fine. And even if you wait then until 9:30, you're still doing your watch list. The type of stock generally is going to be a low float stock under 50 million shares. And so, this is going to be pretty consistent. I'll pull up the gap scanner for today, but these are the ones that I'm typically going to be focusing on. They typically are the ones that make the biggest moves. Now, you could look back at any day in the market. And if you want to look at the stocks that had the highest relative volume, that had the biggest gap, the biggest move, you're going to notice something in common about them. And ultimately, what I noticed in common about these is the legwork that I've done that you don't have to do. A lot of beginner traders, they come into the market and they don't even know where to start. Penny stock, OTC stocks. I mean, I've done so much of this legwork for you. So discovering that it's typically stocks under 50 million shares, but particularly under 10. CHCI gapping up with a 2 million share float, gapping up 218%. And you know what? This one gave us, it gave us a gap and go trade. I'm not going to say it was perfect. It wasn't perfect, but it was a gap and go trade. And you know what? They're not always going to be perfect, and that's okay. We'll learn to capitalize even in the imperfection. So here, this had what we would call a pre-market pivot, which was right about here at 14. It broke that level at the bell, ripped up to $15.72, instantaneous, over $1 a share. Remember, your goal was 10 cents a day. So that was a very nice, pretty clean move. Break at the pre-market high right there at 15. Actually, I think the pre-market high was from like 4 a.m. and it was 15. No, it was right here at 627 at 1538. But all of this was on relatively lighter volume compared to the volume that came in, really between 9 a.m. on the break of volume weighted average price as it moved up. But again, not to dwell on this specific example, just to reiterate the importance of float. The lower the float, typically the more, firing power, gunpowder, whatever you want to say, the stock has. Doesn't mean just because it's a low float that it's going to make a big move, but it's typically the ones that do have a lower float that have more potential. And Garrett said, 10 cents a day, what are we talking about? So just as a refresher, for those that maybe had missed that, one of the things that we talked about earlier in the class in the starter and a few times again in the pro is, can you make 10 cents a day per share? If you can make 10 cents a day per share. 100 shares, yeah, it's only 10 bucks. 1,000 shares, it's 100 bucks. $100 a day is making some good progress. Sometimes we set these big expectations that are kind of not realistic. And, you know, when we see these stocks that make huge moves, sure, it would be nice to capture a big chunk of that and make, you know, have a huge home run and grand slam trade in one day. But realistically, I can tell you, I can actually guarantee you that while I might have a little FOMO that, you know, while we were teaching class, AUVI, you know, ripped here from 16 up to 30. By the way, AUVI was on the gap scan this morning as well. It was gapping up with a 2.6 million share float, 73% with news. So this met all of our criteria. And, you know, I traded it. I made a little bit on it. Granted, it's only 800 bucks. But right now, I've got $14,000 of real money in my pocket. I guarantee you there are traders out there who traded this entire move up that are up far less than me. In fact, there are likely traders out there who traded this whole move and somehow managed to be red. It's easy for us to look at a stock like this and say, oh my God, if I had traded it, I could have, would have, should have, all this stuff. When in reality, that may not have been the case. You may have still managed to lose money. And so rather than always saying how much you could have, being grateful for what you have is really important. And if that's 10 cents a day with 1,000 shares, it's 100 bucks a day. Sure, you could compare yourself to someone out there who made 100 grand on the same stock. Or you could say, you know what, I got to live with me. This is my P&L. I have to own this, and I have to be at peace with my P&L. All right, so price range, so back this up. So low float, under 50 million, but really lower is better. Requirements, the stock should have a catalyst or be a former runner. Sometimes we'll have a stock that just is going and we don't understand why, and CHCI actually had no news today. No news. And, you know, but it gave opportunities, and so we traded it. Price range between $1.50 and $10 is usually best for account building. We can trade higher price stocks. You know, there was a higher price one today, KALV. You know, I mean, it's $40 right now. Pre-market, it actually made a nice move here up to 50. But, you know, sometimes these ones can be worth dipping our toe into. But generally, if you've got a smaller account, you're probably not going to want to mess around with them too much. The spreads get bigger. The whips get bigger, and you can very quickly underestimate that in, you know, one false move, you could be down $1.50 or $2 a share, and you're like, oh my God, what have I just done? So usually cheaper is better, under 20, but under 10 is good as well. Sometimes though, when you have a gapper that's gapping up, you know, from $2 and it's gapping to $4, it's already up 100%. By the time we're sitting down and looking at it, might already be at 7 or 8. It's getting close to that $10 spot. So I don't really set a cutoff. All right, so price range, entry. So once I've confirmed a potential gap and go stock, based just on stock selection, right? We've evaluated the chart based on what we talked about of daily charts and intraday charts, chapter 4 and 5. We've looked at the news, chapter 3. And maybe we check the, you know, SEC filings to see if they do have a shelf registration, maybe. Then I look at the 5-minute chart to determine a possible entry, and then I watch the level 2 to try to dial in my exact entry. So I kind of start big and then dial in more and more and more. I can usually, just by looking at the gap scanner each morning, I can know whether or not it's even really worth rolling out of bed. Now, I always show up, but, well, I say always, but, you know, I usually, I mean, I really do, but you know, who knows? Maybe in the future I'll say, you know what, this is a day I'd rather go do something with my son, and I don't want to mess around with this market. So in any case, today, CHCI, it's 2 million share float. I looked at that. I didn't have to look at the chart to know this is one. This is one that we're going to watch very closely today. This is one. AUVI is one. These two, 22 million share float, not bad. 13 million share, a little pricier. You know, those are maybes. Going further down, these floats are too high. But this is a good day because remember, some days we log in and this is what we're looking at. Ugh. The 5 leading gappers are all 100 million share float stocks. Biggest gappers, 44%. I'm going back to bed. This isn't the juicy, exciting gap and go scanner that I was hoping for. Other times we'll wake up and maybe we'll see something like this. You know, the top 4 gappers are all tiny floats. Now, 16% is not a big enough gap, but let's say those were 76%, 75%, 74%. Then I would be like, whoa, we got some action today. You've got 4 or 5 low float stocks all moving at the same time. It's going to be a day to buckle up. There might be so much moving, it might actually be a little hard. But today was good. And so I knew that just by looking at the gap scanner. So I start with the gap scanner, and then I pull up the chart. I pull up the chart because the chart will pretty quickly tell me whether or not, the stock is, sometimes they'll gap way, way, way up, and then they'll pull way back, and then by the time you're looking at it, you're like, yeah, I don't know, it's got that big red candle, I don't like it. But I pulled up the chart, and hey, it actually looked pretty good. It pulled back here below VWAP, so now in this area, wasn't looking so great. Check the news, there is no news, so I was sort of like, I don't know. At this point, around 8 a.m., I wasn't that interested. I was focusing actually on HTBX at that time. So HTBX was the one I was focusing on there as we got that move from $8 up to like 19. But then CHCI broke back over the volume weighted average price and was proving it was had some strength. And so we started looking at this, and this pullback right here was a nice entry. So first pullback was the setup on that. So how do we find the stocks? Gap scanner. I mean, as a beginner trader, I didn't even know gap scanners. I didn't even know what a gap was. And I had no idea what gap scanners were. And I certainly I didn't know to Google that I needed that tool. I just knew nothing. I was like a blank slate. So I'm so glad for you guys that not only, we're able to provide the scanner for you guys that we built, and it seems to run really well, happy with it. You know exactly where to look in the market for the action. So gap scanner, how do we find the exact entries and exits? That's what I'm going to be showing you through this chapter. And this just goes to show this was a period of time. I don't remember actually what period of time this was, but in any case, this was a period of time where I had over $1 million just between 9:30 and 9:45. This is broken down by 15-minute increment. Literally 15 minutes between 9:30 and 9:45, $1 million. 9:45 to 10, whatever this is, 300,000. From 10 to 10:15, a little less, a little less, a little less. Now, it's actually changed a bit here. I don't know why. I kept refreshing this. It's like, there it goes. Okay. So actually, we've got another one we're going to import. So we're going to import IRA, add, and let me just grab this. So, oh, come on. Oh, did I delete that? No, hold on. I just want to import that because we're going to want to go over some of those trades from yesterday. So my metrics have changed a little bit in the last year, and they've changed really because we have seen this this real shift in the market where we've just seen some incredible volatility pre-market. All right, so, import IRA. So this is how you import it. You just add this, you grab your file, and there it is right there. So that should import. I'm pretty sure that's the right file. By adding the tag, I can always zoom in to the specific date, and then I can highlight that date with the tag, and if I have to remove the trade, I can remove it. But all right, so reports view, so we'll go detailed, and let's go days and times. So we break this down by 15 minute. You'll see that I got a couple trades on GME at 4 a.m., half asleep, but I also got smoked on a couple of trades. So I've got $50,000 to show for waking up that early. I don't know. So anyways, really it starts to pick up for me in the last 12 months, around 7. This was one trade. This was one catastrophic trade that happened, and that's life. But anyways, so this is kind of my window right now. Pretty strong generally from 7 until, about 11:30. And then it starts to get a little choppier later in the day. That's by 15-minute increment. We go by 30-minute or 1 hour, it shows a little bit better. It's such a bummer I had that one huge loss. If we went back to 1/1/2019, 1/12/31/2019, you would see a little bit of a different pattern here, which was really quite consistently starting never before pre-market, and then 9:30 and dipping down. But this market has called for more pre-market action. So all things considered, I've still made a lot more in that same period of time from 9:30 to 9:45 in the last year, but worth noting. So in a 6-month period where I generated approximately $600,000 in gross profits, only $30,000 was attributed to pre-market trades, which was only 5%. However, in another 6-month period where I generated $4 million in profit, $1.2 million came from pre-market trades, which amounted to more than 25%, showing us that shift in the market. In extremely hot markets, we sometimes find that because gap and go trades have been working so well, stocks with news or even without squeezing up at the open, that traders are beginning to buy the stocks moving up pre-market rather than wait for the bell because they want to be holding it for that big move. So this can provide an opportunity to trade pre-market, but I would generally only take the trades if the stock already has at least 500,000 shares of volume. Now, sometimes There are times where I will see a stock, it'll be on one of my scanners, and I'll see it ripping up, and I'll jump right in. You know, and those are risky, especially when they're light volume. But if we're in a hot market, and I'm one of the first people perhaps to see the stock, because of course I have these tools, which you guys all have access to, but they help us find these in real time, then, you know, hey, you're the first one to see it. Good for you. Jump on. But you just have to be careful, because lighter volume can mean bigger spreads, and it can mean they can reverse quickly as well. So if we are seeing big moves pre-market and you feel you keep missing them, you may want to start trading a little earlier. Starting with smaller size is important, but having a loss early pre-market, and I'll move my video here, the nice thing, if you do have a loss early pre-market, is that you've got a lot of time to recover the loss, as long as you haven't gotten yourself emotionally triggered because you hit your max loss. So that's why starting small and kind of starting to build that cushion is important. But this is an example of why I rarely hold from pre-market into the open, and I touched on it at the end there of chapter 6. At the bell, remember that there are people that, you know, have those orders out. So in, you know, so my wife and I we are holding Etsy. So, you know, let's just say we put an order out on Etsy to sell our entire position at $300. Let's just say, for instance. You know, well, $300 one morning, Etsy, you know, has a big gap up to $350 pre-market. Well, $350 pre-market, our orders are not going to execute pre-market, right? They don't work pre-market. So as soon as the bell rings at 9:30, boom, our order is going to execute, probably along with a lot of others, sell order right at the open, and it flushes. And this is an example here where this stock, ACB, which had a higher float, was pre-market at 15. The bell rings, it opens at under $12.50, down $3 a share. It rips right back up and fills the gap, but oh my gosh, that's stressful. So that's why I usually don't want to be holding from pre-market to the bell ringing. But having said that, there are times you will see me hold from pre-market into the bell, and with CHCI today, that would have been perfectly fine. In fact, there's a lot of examples of when that would be perfectly fine. But sometimes, you know, you have that risk. So I usually try to close up my positions before the bell rings. And to be honest, between 9:15 and 9:30 usually isn't the best time for me to be trading pre-market. If I'm going to trade pre-market, usually I'd be trading quite a bit earlier, you know, 8 to 8:30 or 7 to 8, something like that. Right around 9:15, 9:20, we're just getting so close to the open. Some brokers also, if you place an order to buy right before the open, they won't let you cancel it because they start factoring in your order as part of the imbalance. That's not true with Lightspeed that I've ever had happen, at least, but that may be something to be mindful of. So I do usually exercise caution when it comes to considering holding from pre-market into the open. All right, so I'm going to go over a few of my kind of favorite case studies of some gap and go trades. These will, each of these setups will have their own examples in the live trading archives. And this is just kind of setting a little bit of the groundwork for what you're going to be seeing in each of the subsections of chapter 7 here. So in this case, on this day, NNDM was our second leading gapper. You can see it right here. It's gapping up 59%, 4 million share float. The colors here are different. This was a software that I used to use, and then when I built my own scanners, now we use this different software, our own. So anyways, colors are a little different, but NNDM, second leading gapper, gapping up 59%, 4 million share float, 6.2 million shares of volume. Here's the headline, May 19th, 2020. You know, you've got this headline here, which you can read through it. You could go into a lot of detail on it, but the fact is the market's responding very well. This is the chart. Pre-market, you can see here at 6:15, kind of consolidation. Right around 7, it actually squeezed up. About 8, it hit $1.50. It dropped down, back up to $1.50, closer to 8 here, actually. That was a little before 8. Then at the open, you know, kind of choppy. Pops up, drops down, and then it starts to break through those pre-market highs. Hits a high right here, kind of chops out a little bit, drops down, rips up, and now we've got first pullback, second pullback, third pullback. And we get a squeeze on this from $1.50 all the way to 3. That's a nice move. That's a really nice move. Now this, not the perfect gap and go stock, in fact, because at the 15-minute sort of 9:30 to 9:45 window, it wasn't super strong. It did give some opportunities pre-market, and then the opportunities started to open up a little bit more here on what we might call a red to green move. or an opening range breakout. And then through this area, these are more of traditional momentum trades that we'll be talking about more in chapter 8. Buying the first pullback, the second pullback of a stock that's strong, regardless of whether it's a gapper or not. It doesn't really matter. At this point, yes, it's still technically a gap and go because it gapped up and is going higher, but this is a momentum setup right here. So, of course, it's hitting our high day scanners. It's squeezing up. And on that one, I locked up $8,800. Not bad. Pixie, same day. This was the leading gapper. This is the one that everyone was really watching. 78% gap, $11.40, a 300,000 share float. That's tiny. What a tiny float. So Del Taco franchisee partners with Shift Pixie to combat COVID-19, a COVID-19 catalyst in May of 2020. That's all we needed. Look at this. Look at that picture perfect pullback right there. See that? Now this started early, as you can see, on light volume. The volume increased. In fact, it increased really around like 9 a.m. So volume early was pretty light, but it definitely moved up from 6 up to about 850 on light volume. So we always know that light volume ones, they can definitely be tricky. There was actually one this morning. Let me see if I can find it. Let's see. Oh, CBIO. So CBIO this morning popped up. And on this one, look at this. I mean, this is kind of like, you don't like to see that. This went from 640 up to 880 at 9 a.m. and then came right back down. So you do have to definitely be careful trading these early pre-market. Sometimes, if they start to go the wrong way, you definitely want to move out of the way. But there, perfect pullback. And that rip from 10 to 11 to 12 to 13, pullback, rip at the open, halt going up. Stocks don't halt pre-market on circuit breakers. No halts pre-market on circuit breakers. So sometimes we will see these really big rips or even big flushes. At the bell, opens, halts up, opens higher, squeezes up to 1550, pulls back, breaks below VWAP, and then gives a secondary trade. $40,000 in profit. MDGS, it's on my morning scans. Leading gapper up 81% with a 4 million share float. We've got a headline here related to COVID. This is the pre-market chart, kind of sideways really, but clearly if it can break over the pre-market high of about 440, that would look pretty bullish. And in this case, it does a red to green move. It goes red, and then as it surges up, first candle to make a new high is the red to green setup, and it rips up here, pulls back, does it again. So this was a stock that was performing a little bit better on pullback entries and the red to green setup. Not a huge winner, but $7,360. $9,000 green day. The other trades were small. One break even down to 0. APOP near the top of my gap scanner. The leading gapper was ACB, but a 1.16 billion share float. No interest and lighter volume. APOP gapping up 117%. And actually, this most likely was a reverse split. It's unlikely that it was actually gapping up 1,000%. It was probably a 10-to-1 reverse split. APOP. $5.16. We've got a headline here, and this is pre-market. So we get this move pre-market around 7:30 from 4 up to 5, hits a high here. This is all the institutional trades that go through right around 8 a.m., those candle wicks. And then at the bell, it kind of sells off, tries to do a red to green, rejects. Tries again, rejects, but now it's holding this sort of support line, which provided some dip entries, was only able to make about 3,800 on it. Wasn't really a big move. Looking at the chart, you can tell it. It's not to say you couldn't have made some money on it, but it wasn't as easy. SIF, another gap and go case study. Gapping up 62% with a 4 million share float. Lighter on volume, but with news. So if we're the first ones to see that news and recognize the opportunity, that's fine. And here you go. Pre-market, not a lot of action, but at the bell, it squeezes up here to 440. It pulls back and does a 1-minute micro pullback and then moves from 420 up to 560. Not bad. $8,635 of profit. XRF, top of the gap scanner, 5.8 million share float, gapping up 118%, $2 stock, little on the cheaper side. But, there's a catalyst here. It's also a Chinese stock. So we know that some of the Chinese companies will kind of, for whatever reason, they have their little momentum cycle that they go through. I bought XRF at the open for the gap and go and got the squeeze here from about 210. Up to 240, pull back up to 250, 260, pull back up to $3. Not bad. $8,595. Is it a home run? Probably not, based on what I would consider to be a home run, but not bad. IO, top of my scans. So here we go. IO, $3.23, 93% gap, 12 million share float. We've got news, first quarter 2020 results. Here's the chart. That's nice. Micro pullback right there at the bell, breakthrough 350, rips up to just over 4. That's almost picture perfect. That's actually very similar to what we saw on CHCI today, a break of that pre-market pivot, which was 14 on CHCI. So the more you see those patterns and learn to recognize their potential, of course, the better you'll get. So we'll look at CHCI here just quickly as kind of a reminder. Now, why is it here, you can see fairly similar, this move up, the pullback, the little move up, the pullback, and then the breakout. Why did this one just go and keep going and this one reversed? Well, maybe this one reversed because it didn't actually have news. So short sellers were a little more aggressive, but sometimes those ones keep going anyways. There's not always a logical or clear explanation, but we just trade the price action. So let's see, this one IO, $11,000. This is a case study of CDTI, Clean Diesel Technologies. Pre-market high was 251, gap and go. Now this was gapping up only 13%. This was years ago. This is 2015. This is a much calmer market with only 43,000 shares of volume. But the bell rings and it rips from 250 to 340. That was a nice quick opportunity. But the biggest gapper, only 13%. Can you imagine? Oh my goodness. Here on this day, biggest gapper 43%. And this one, OHGI though, that 16% was the one that we were watching. The bell rings. This was a little bit of a continuation setup. And look, it just basically rips right out of the gates. Probably a hard one to manage risk on because it just went straight up. But that's a 5-minute chart. And what I can tell you is that on the 1 minute, we had micro pullbacks right in this area. Gevo, another case study, 1 million share float, $5.20, gapping up 48%. Pops up here, pulls back, rips through that open, continues higher. So by this point, this is more of it is a red to green move, breakthrough VWAP, but more of a momentum trade at that point. But still a stock that would have been on our watch list, and therefore we would have probably had on a chart and be watching it, at least somewhat closely, knowing that there's a possibility it could break through its pre-market highs. TBLT, 184% gap, 4 million share float, $4,900 of profit. Is it a home run? No, but it's not a bad trade. Pull back once, twice, 3 times at the open, rips here up to 555. ZKIN, another one. Nice pre-market, a little choppy, but a rip right out of the gates. It's the leading gapper. I often will tell you that I want to be focusing on the leading gapper. When the leading gapper fits within our strategy from the perspective of price and float, and the chart is decent, and we have a catalyst, it's usually going to be a pretty good day. Now, sometimes those will, they'll disappoint us, but usually we're setting up for a pretty good day when we have a good gapper that fits our criteria. On a day where we don't have any good gappers, that can sometimes set the tone for the entire day. And I'll say that, yes, ZKIN, the pre-market chart, is not as clear, except that it was the leading gapper. And so for that reason, there were a lot of eyes on it. And also note that this is a 5-minute chart. So on the 1 minute, I think there were probably some opportunities on it, maybe a micro pullback or something. Not a perfect chart, though. I would agree. It's not as clean of a chart. But just the fact that it's the leading gapper, a lot of eyes on it, and therefore it did end up having nice follow-through. So, however, it's also worth noting that when we have the leading gapper fail, when the leading gapper fails, which was the case today with CHCI and HTBX, the leading gapper's failing, gapping and selling off, which therefore on the daily chart become red candles. This is not as good for momentum. And sometimes that can set the tone for the rest of the day. Now, fortunately today, AUVI has held up fairly well, is still holding up relatively well, although on declining volume. But it usually is worth noting, is the leading gapper performing well? And if the answer is yes, then I would sort of think, okay, the market's still pretty hot. If the answer is no, then I would be a little concerned that things are perhaps cooling off. I think sometimes short sellers see the leading gapper failing as kind of like blood in the water, and then they start looking for other things that just are going to pop up and fail. Whereas when the leading gapper is really strong, it's like, okay, whoa, let's sit back. We're in a strong market. As a short seller, let's be careful because things are just going crazy. And it's that sympathy momentum. When one stock is strong, often 2, 3, 4 others are strong as well, as traders just start to get in that feeding frenzy and jump from stock to stock to stock. BPTH, from $6 to $14, but you can tell in this one on the 5-minute chart, I mean, you had some pullbacks, but it was definitely a little bit different grinding price action than some of the others that just go straight up. But what we knew on this was a very low float, gapping up 55%. You know, everything was working and was right on this. Leading gappers were right. FTNW, 9 million share float, but 200% gap, a rip up, pre-market, pull back, first candle to make a new high at the open right here, over 350, made sense. Not a home run, but a couple nice little trades on it. So my process of reviewing the gap scanner is to review the gap scan results right here, try to identify the catalyst, review the daily chart. Well, so the first thing is I just look at I just look to see, I look at the results. And then the second thing I do is I look at the pre-market chart. Because if the pre-market chart is terrible, then I don't even have to go through the rest of the process. But if the pre-market chart is good, then I go ahead and look at the next thing. So let me back this out here. Let's see. And I'll go, so step one is there. Step two is review pre-market chart. Then step three is identify the catalyst. Step four, maybe at that point, check the daily chart. And step five is then identify the entry points based on the setups that we'll be discussing. Okay, so I just fixed that real quick. Gap and go trading is about choosing the best stocks. And it's not always a good idea just to choose the best stock today if that's not really a good stock. You know, the best of today, I mean, if the best of today is, you know, we're looking at a gap scanner like this, it may not be worth it. It may be better just to sit on the sidelines and say, you know what, I don't think I can do it today. So we really want to focus on the best quality stocks. I select the stocks I'll use for the gap and go strategy based on float, size of the gap, the catalyst causing the gap, how familiar I am with the stock, the amount of pre-market volume. And I always mark out the pre-market high and the high of any pre-market consolidation if there is any, which I'll show you examples of as we get into the different strategies. But remember, the reason the gap and go strategy works is because other traders essentially practice a variation of the same strategy. They see a stock moving up, whether they log into Robinhood and they just see the top gainers on the day, they see it's got a catalyst. This is just the reality of the market. Its stock is gapping up, people buy what's going up. People always say when the market's crashing, you should be a buyer. But that's never what people do. The market crashes and people sell. The market rips and people buy. People like to buy what's moving up. They see it moving up, they think that there's more potential, and oftentimes there is, but it is a bit of a self-fulfilling prophecy that because so many people buy stocks that are going higher, they continue going higher. So we want to be trading the most obvious gappers because that's the same stock everyone else will be looking at. And the question really is, you know, where can we find good entries and how can we trade it without taking crazy levels of risk? And how can we make sure we're not still in if it starts to roll over and we're not the one that's just holding the bag as it drops? And the new jungle gym on the playground is kind of, you know, in elementary school, they've brought in a new piece of equipment. Everyone's excited about it until the next one comes in. And sometimes people are very fickle and they'll jump from one stock to the next one just so quickly. It's like, wow, people just really gave up on that. I'm going to fix this for the gap and go strategy. Okay. So this is a good pre-market chart, I would say. You can see how we have a nice move up, a pullback, a move higher, a top at the $0.50, 849, 850, a pullback, a pop up, a pullback at the open. It makes sense to be looking to be buying over 850. And in this case, it ripped through 850 and went right up to 950, 1050, up to 11. Pulls back, consolidates, and then through this area, a momentum trade on the break back through 1075 through high of day. This is a decent pre-market chart, lighter on volume, but not bad. So, you know, this would be an example of one where we would say, gosh, the volume is probably less than 500,000 shares, but it's clearly moving up. You know, it's up from the previous day. It looks like over 100%. So, you know, that's a pullback. Pre-market high is 20, and it rips through 20 to 23. This is a good pre-market chart. Consolidation right through here. We'd be looking at the break over $2. You can disregard some of these indicators at the bottom, probably something I had on there for a student that I was doing a session with. This, I would say, not as great of a pre-market chart, stair-stepping down. Now, if it opened here and held and started to curl up, okay, but it's got to really break out of that pattern and break over $1.90. And in this case, it opens and just washes out. So this is a gap and fade. This is a pre-market chart that initially looks great, but then pulls back, and by the time the bell is ringing, has broken this bottom and is really sold off too much. So that doesn't look as good. This one doesn't look as great. It was looking good. A nice move after hours, pullback, pre-market, it rips higher, and then that was early and starts just fading. Doesn't work. Another one here, strong in the previous day, strong after hours. By the time the bell is ringing, it's fading. It's just pulling back. And I want to show you a few of these examples just to kind of help orient your mind to visualize what is a good looking pre-market chart and what doesn't look so good. So, you know, this right here looks pretty good. Nice pre-market, nice pre-market. And the fact that it failed here is not because the pre-market chart wasn't strong. It was a good pre-market chart. Why it failed here, I don't know. The catalyst or the trigger would have been a break over the apex point, $20.40. But in this case, it popped and just sort of faded. Could have been related to the catalyst not being strong enough. It could have been something else, but could have been that it already moved enough pre-market that traders got their piece of the action and then didn't want to risk it. It could have been there was a gapper that was a little bit better, that was more interesting, and people were focusing on that one instead. Sometimes it's not that this wasn't good, it's just there was something else that was better. This one, a little extended coming into the open. So, you know, a little extended coming into the open, by the time you get the bell, sometimes you get that final squeeze, but if it's already extended, that can be a little tricky. This one here, already a little extended into the open. It really hasn't had a good opportunity for a nice pullback, but if it broke over the pre-market highs, that would be worth watching. So how to trade the gap and go. Now you know how to make your basic gap and go watch list. Just, again, we're gonna get into more detail of the charts and the setups, but you know the basic process of opening the chat room, looking at the scanners, and asking yourself the float, then what's the pre-market chart look like? Is it relatively bullish, or is it bright red? Is it just selling off? How strong does it look? Your eye will get better at recognizing those strengths and weaknesses, and as you see more examples, you'll get better at it as well. And so now when the market opens at 9:30, or when we're considering a pre-market trade, the question is, where is the exact entry point? And that's going to be based on the strategies, and the strategies are based on specific patterns. These trades can be very quick. They can be as quick as 1 or 2 minutes. They could be, you can be as quick as a few seconds. They could be 3 to 5, 10, 15 minutes, depending on the strength and depending on whether or not we're holding into a circuit breaker halt, if it's really, really volatile once the bell rings. We still have to refer back to our 2-to-1 profit loss ratio. If I have a 10-cent stop, I want to make sure I have the potential to make 20 cents of profit. So making sure my stops are relatively tight and my profit targets are realistic is definitely important. At the moment of entry, I'll be closely watching the level 2 window, looking right at the ask and glancing at the tape, glancing at the bid, looking for big buyers and big sellers, and looking for that flow on the level 2 that indicates that we're starting to get a breakout. Our order entry window right here is usually where I'll be preparing my trades. So, you know, if I know that I like a stock over 235, I can go ahead and enter that price right down there, and it's ready for me to click the buy button. I could, you know, set my share size, so I have everything ready to go. Now, the way I trade, and let's see, let me open this back up. I usually have, at most, 4 windows right here. So 1, 2, 3, 4. Now, I'm not always closely watching 4 stocks. I usually have 1 or 2 that I like pretty, you know, I'm watching them pretty closely. And then these might be ones I'm not even watching at all, and I could just, you know, kind of just make it empty and just type in a random symbol, goes away. So usually just keep it simple and focus on 2. But, you know, if I have those 2, have the order ready at 9:50 or at 13:50, and all I have to do is click the buy button. When the bell rings and I see that setup as it's, you know, as it's starting to open up. I'll sell when I hit my first profit target, usually taking a little off the table. Sometimes when we get a stock that rips really quickly, I'll hold the whole thing for a bigger move, or I might even add into it. That's going to be more aggressive. Typically, as a beginner trader, you want to be really careful about adding into those squeezes and instead be focusing on taking some profit off the table just to pay yourself. You want to be green, even if you're not hitting home runs, just consistently green is a great start. And then adjusting stops to break even if it does come back down. Common gap and go exit indicators for pretty much all the setups. I will sell if I begin to see heavy resistance on the level 2. The 600,000 share seller on SRNE at $10. That's a problem. Usually I'll bail out just by hitting the bid. If I see a big seller on the level 2, I could try to sell on the ask just below it, but other people see that same seller, I'll probably have to hit the bid to exit. If I'm in a trade and I stop seeing buying and I'm just seeing a lot of selling, you know, that for me is an indicator of weakness. Now, if I'm already up a lot in the trade, maybe I could hold a partial position through that period of sort of choppiness, but I'm usually going to be thinking that this is not great and I may need to start seriously unwinding this position if I haven't taken any off the table. If my first profit target is touched, I'll often sell half on the ask, adjust my stop to break even for the remainder. So if we get that extension, I can take some profit and then wait for the next pullback to add back whatever I sold for the next leg higher. If second and third profit targets continue to hit, I'll continue to sell small pieces on the ask, selling a quarter, selling a half. I'd like to not sell the rest of the position until the first really obvious sign of weakness, which could be the heavy resistance on the level 2, the bunch of red cells on the time and sales, or a red candle. So if on the 5 minute a candle closes red, that's for sure not good. But even on the 1 minute, the first red 1 minute candle, that can be the exit indicator. And remember the mentality of breakout or bailout. The best gap and go trades work instantly, whether it's pre-market, regular hours, or later in the morning. The best trades work instantly. If it doesn't start working the first 5 minutes of entering the trade, I just would prefer to get out, break even, or for a small loss. Or cut the trade in half and hold a smaller position. If I go in with full size, I'm expecting pretty much immediate resolution. If I don't get it, either my timing is wrong, I thought I saw something that just isn't there, or there's a big seller. So I don't want to get caught in those bull traps. I want to just get right out of the way. And I'll just back up here. So I'll move my video just up to the top there, just so you can see the rest of that. So yeah, that was just on the 5 minute chart, but same on the 1 minute, first red candle. And I would encourage you in the simulator to be fast. See how fast you can be. See how quickly you can get in and sell. If you're in at the apex point, if you're in at the right point, you're going to see instant resolution. So how quickly can you press that buy button and capture that profit? So this one's not really moving enough right now, but AUVI, let's say a possible entry on this could be, let's see, maybe the high of that last candle is 24.71. There's a 10,000 share seller. This isn't really a good setup right now, but let's just say I'll just hit the buy button right here. Oh, I've got to go change that. So let me go into settings. Go to view, settings, hotkeys, and we're going to change this to load and go, and we're going to change it to share size 1,000 shares. Okay, so on something like this, let's say I'm going to punch it there at 53.52. I'm looking for immediate breakout. I want to see a rip to 53.70. 53.70, 53.69, my order's on the ask. It's not filling. I put another order on the ask at 67, I'm out. How much did I make on that trade? $110. Now, that's just an example. This isn't really a good setup, obviously. It's kind of a weird pattern. You're not even looking at the chart, but I'll show you the chart right there. So this is sort of the pattern here. It just sort of popped up and pulled back. The 5 minutes sort of a mess. But let's just say, a trade like that, okay, the next order's at 24. Can we get the break of 24? Right? So we're watching 24. We're watching the tape. We see, let's just say, that burst of green. First 1 minute candle to make a new high on this would be over right around 24. So watching, looking for green, looking for signs of strength, hands on the buy button, ready to punch it. And there, I'm in. Okay, now I want to see it break over 24. All right, so we're going to get the break of 24. There's 20, there's 91. There we go. Selling on the ask. I'm out. I'm all out. And just like that, boom, that was, that ended up being a nice trade, $710. So this isn't really, again, this isn't a gap and go, but just that, can you trade that quick? Can you get that profit? Can you capture it? Can you lock it up? And then can you say, hey, I'm up $710. I'm grateful, and I'm going to take that money and walk away. As a trader in the simulator, more trading is better. And even that example right there, if you were trading a simulator at 12:30 in the afternoon, well, that was a little opportunity. You would probably find yourself getting frustrated the later into the day you trade at how choppy things can be. That was just 24.20, and then it dropped back down there to 23.66. That's typical of this time of day. But what you do gain at least, and you could see in that example, and the high here of this candle is 24.71, you can see the flow of volume on the level 2. This is a stock that's moving pretty quickly. So this is one that if there was any that were worth watching and trading in the simulator, this would probably be one of them. Trying to do this on like General Electric or something like that, it's not going to work so well. But the next setup here would be possibly a break over 44. So new order would be at 24.50. Looking for green on that tape. You start to see that green, that sign of strength. Boom, punch the order. How quick can you be? You have to be ruthless. You have to be aggressive. You have to be aggressive both in capturing your profit and in cutting the losses. It's so important. Be faster than you think you should be. Try to see how fast you can be, just to get in, get out. And you're going to recognize if you have the right entry, your trade's a winner instantaneously. It's almost instant. If you have the right entry and you're focusing on the right stock. I mean, and that's when trading starts to become a bit easier. So here we're still watch that right there. So jumped back in right there at 55 for the break of the $0.50. I knew that was a spot to watch. Now stop is break even. Is it going to break over 25? No, I'm going to hit my hotkey's not working. I'm going to sell. So this is fumbling. So my hotkey didn't work. I got to sell here, and I'm just going to sell right there. So my hotkey, Control Z. What is happening with Control Z? There's another, something else is overriding it. Is it this? Yeah, so sometimes, my presentation pointer, this stupid tool, which doesn't even work well. So I'll change it to Shift 0. But because of that, that tool, sometimes you have conflicts. So you have perhaps software that is conflicting with another piece of software, and then your hotkeys won't work. So that's something to be mindful of. Anyway, so $800 there. How fast can you be? Now, I understand. I understand that some of you are going to say, Ross, I don't have the aptitude to be this quick. I can't be that fast. I'm not fast enough on the keyboard. I'm not a fast enough typer. I can't be watching level 2. My hand-eye coordination, it's just not fast enough. And that's okay. It may not be your strategy to trade that fast, but I want to encourage you to try to practice being a little bit quicker and to try to work on that hand-eye coordination to get to a place where you can see what's happening on the level 2 and start to respond. And if you decide that you would really rather focus primarily on stepping back away from the 1-minute chart, which is very, very quick, and focusing on the slower 5-minute chart, look at some of these patterns. We start to step back to the 5-minute chart and things start to look a little cleaner. First 5-minute candle to make a new high, right? First 5-minute candle to make a new high. There's nothing wrong with stepping back and slowing it down on the 5-minute chart. And you can certainly, if you feel that it's more comfortable to point and click and use the hot buttons down here to click to buy and click to sell, you can absolutely do that. There's nothing wrong with doing that. You should, for sure, test out these different things to see which workflow, fits best with you. But the reason I encourage speed is because there are some of you out there that do have that aptitude and will be able to capture that profit quickly. And those that have it, I really think that you have the potential to do really, really well in a fast-moving market. And I want to see how quickly you can do it. But again, you can certainly slow it down. There's nothing wrong with stepping back to the 5-minute, stepping a little bit away from level 2, and you can still trade the gap and go in a similar way, looking at those patterns. So you can do it both ways, but generally, if you start focusing on the 5-minute time frame, your average winners will be bigger because you'll catch these huge moves. But your accuracy is going to go down. And the accuracy is going to go down because of false breakouts. False breakouts that someone maybe reading level 2 might have seen, maybe not, but might have seen. And so generally a 5-minute trader will have a better profit-loss ratio and poorer accuracy. And that's a trade-off. That's okay. You could potentially still be just as profitable. I mean, as someone who's a 1-minute trader trading quickly, it's a trade-off. So you gotta find what's a good fit for you. But if you're really trying to trade these as aggressively as I do, you're going to want to learn to be fast. And again, certainly in the large cap room, that slows it down a couple more steps even behind trading the 5-minute chart on some of the momentum stocks that I'm trading. The way Roberto trades and some of the other students, both 100K Club students and traders in the large cap room, they're definitely slowing things down quite a bit more and maybe holding stocks for 15, 20 minutes, 30 minutes, maybe longer. So it's not to say that there's only one way to profitably trade momentum, but this is the way that has worked really well for me. And that's why you're here. You want to learn it. So during this chapter, there'll be a lot of live trading archives. Through my trading, I have a practice generally of trying to upload examples that I think are really good. I don't upload every single day of live trading. I just look for days that are specifically good examples of, a stock that's going crazy like GameStop or something like that. So those will continue to get added to the live trading archives, which, for you are an opportunity to go back and rewatch them. So a couple that I have here that I need to work on. So this was GameStop here. This was the day that we had this crazy sell-off, if you recall. I'm trying, oh my God, this is crazy. This is so crazy. So let's see, let's back this up. So on this one, it looks like I'm long this. So we get the resumption. So it's halted down right now at $126. And so I'm going to actually upload this to its own little section, which is going to be the GameStop case study. But anyway, so the halt time was 19:33. Resumption should be 24:33. So let's roll this forward. 24. All right, so we're close enough. So in this case, this was actually a typical reversal trade where I let it sell off and then bought as I thought I started to see some strength. And this ended up being massive. So it sells off. I take a start of 200 shares. Now I'm seeing green. I'm seeing the green. Here we go. Halt level up 32. There we go. It's game time. It's game time. This ends up bouncing from down there. Look at how, oh my God, can you believe that? This bounced from $118 to over $200 a share. Yikes, that's crazy. So anyways, those are live trading archives. That's not a gap and go, but anyways. So with that, why don't we jump into Chapter 7, Setup 1 for gap and go trading, the first and second pullback. Okay, so we're going to continue on here with Chapter 7, Setup 1, the first and second pullback. So this is probably the most common gap and go trade that I'll take. And it's the first and second pullback. So it's a gap and go stock, a stock obviously that's on our scanners that we've evaluated based on the float, the gap up, the volume, the catalyst, the daily chart, and we found an intraday opportunity. It's squeezing up and we're looking for that first pullback. So in the case of, look at this AUVI going higher. In the case of CHCI, but no FOMO, gonna look away from that. Back here on CHCI, first pullback, like that, that's a totally valid gap and go entry, first pullback after it broke VWAP. Now, some are going to be cleaner than others, but that was fine. That would have been a fine entry. So our first pullback, as you know, because we've certainly talked about the first pullback pattern, both in the starter and in Chapter 5 with intraday chart patterns, our setup here is the first candle to make a new high. So we let it pull back, and then first candle to make a new high, boom, that's our entry, looking for that squeeze higher. Now the first pullback can also take the form of a flat top breakout. It's not always a perfect bull flag. Sometimes it is more of a flat top pattern, and that's okay. So I'm going to read this slide to you. And let's see, I'll put my video in the top corner. I'll make it just a little smaller. I'll put it on this corner. All right. So the entry, the first candle to make a new high, the apex point of the bull flag or flat top pattern. That's the entry. Sometimes I will enter early to anticipate the breakout. If I'm entering early, what typically triggers the decision to enter early is either a break through a psychological level that's just below the apex point, such as a $0.50 or a whole dollar, or seeing a surge of buying on the level 2, or perhaps seeing a really big buyer on the bid that then makes me think, okay, big buyer on the bid, I have this psychological backstop, which is that I can get in right here, and if it doesn't work, I can always turn around and hit the bid. I can sell right there. So I would almost always prefer to have an early entry because it offsets the risk of a bull trap or a false breakout. When we have a stock that, I get in right at the apex and it breaks by 2 cents and then flushes dramatically, I'm in right at the top. I mean, in the case of a flat top, I'm in at the top. But in the case of a bull flag, I'm just in right at that critical level, and if I'm wrong, then the loss is going to be bigger than if I was able to get an early entry. So I always look for an early entry, and typically when we have a stock that's really strong, we will be able to find early entries. So in the case of CHCI this morning, we can make this kind of bigger here. Well, I'll move my camera again here to the other side. So in this little setup right here, this is actually going to be, I think, an okay example of this. So right here, this is our 10-second chart. So the reason that I'll sometimes use a 10-second chart is to help me visualize the pullback that's happening on the 1-minute chart. So right here on the 1-minute chart, on this candle, that time right there, if you see my cursor, it's drawing a vertical line So it's showing me where on this 5-minute chart or 1-minute chart I am on the 10-second. So this right here was a 1-minute candle, that red candle. It hit a high right here, and then it pulled back down. So the high of that candle is 13.50. Psychological resistance at the $0.50. It flushes down to 12.40, bounces back up. It pulls back, it pops up. We're starting right here to form an ABCD pattern. Now, this is a very micro ABCD pattern on a 10-second chart, but the pattern is there. So I recognize that now, possibly over the high of this point right here, could be a little breakout. And in fact, it does pop up. It goes a little higher, then it surges to 13.27. It drops down, but then right back up. And if it breaks over the high there of 13.27, now we're looking at the break through the high. So the first 1-minute candle to make a new high right here was actually about 13.05. It was this entry right down here, which, you know, is kind of a funny entry, but this helps provide a little bit of context to it. And then right up here at 13.77, that's a flat top breakout right here. Yes, it's kind of zoomed in, obviously on a 10-second chart, but it taps 13.78. It pulls back, it comes back up, breaks through that level. That's an add, rip through 14 there up to 14.23. And that gave us that extension there as it started to squeeze up and move higher. So in this particular instance, if the first 1-minute candle to make a new high is 13.05, would it not have made sense perhaps to take an entry at 12.99? To take an entry to anticipate the break through that level? And in my opinion, that would have been a smarter entry than getting in at 13.05. Get in just below that psychological resistance. See if it does crack right through it, maybe even at 13.95, 13.98, 13.99, then the break through 13.05. Now it breaks through that, it pops up, pulls back, holds 13, it dips below it, comes back above it. And so in there, you've got that nice ascending higher. If we wanted to draw an ascending support trend line, we certainly could, and we would see that we're starting to get some respect on this level. It's not picture perfect, but you know, it's there. So let's back this out again. So almost immediately upon entry, I want to see that the price is moving up. If the price moves down immediately, my timing is wrong. If I have a starter position, I may hold it with a stop at the low of the pattern and look to add near support, which would be averaging down, but I'd be willing to do that if I have a starter position. I would be very, very cautious as a beginner trader about adding to a loser. I think it's probably better just to cut the loss, but there are times where you will see me average down because I only have usually at that time a starter position. However, when I go red on a trade almost immediately, I often have to change my perspective from this being a winner to getting out break even at best, maybe adding near support and then getting out at break even because I've reduced my cost basis, or just cutting my loss. So this is the type of trade, the first candle to make a new high, that when it works well, it works almost immediately. That's why I like it so much. Instant resolution when it works well. And it works the best, of course, when we're focusing on the right type of stock to trade, when it has the right flow, when the price is right, when it's the right time of day, which is, you know, pre-market up until like 11 a.m. And I know today, right now, at, you know, a little past 1 o'clock, we do still have some momentum on AUVI. It's halted coming back down now. But, you know, and you can see how that is a micro pullback there. So, you know, if this was one you wanted to be practicing just for the heck of it. But trading later in the day, notice how this move higher, the divergence that it's on much lighter volume than what we had earlier. This was high sustained volume. This is lighter volume. A divergence moving up on lighter volume can be the beginning of a big sell-off. So afternoon trading is really only for losers, and I'm just kidding, because I was trading afternoon yesterday. But really, it's just something to be very careful of. You can trade afternoon. If that's the only time of day that works for your schedule, it's fine. You just have to be mindful that you're trading the right type of stock to trade. So again, right type of stock to trade. So the target. Okay, so this was the entry. This slide, we're talking about the entry. The target. The target is usually a retest of high a day and squeeze through the breakout price. Due to the inherent risk in any breakout trade being a false breakout, I will often take some profit into that first surge, selling a quarter on the ask, a little more on the ask, and then perhaps selling on the bid if I have to, and adjusting my stop to break even. Remember, when I use the word stop, I'm referring to a mental stop, not a live stop. Mental stop at break even. Sometimes when a stock holds through that first breakout, I will add back to the position that I sold, add back for the next move higher. And so what's very common for me, And we'll see in the live trading archives, but we'll be add, sell, sell, add, sell, sell, add, sell, sell. And I'd be doing that, timing the waves as it's rolling in, as the momentum is rolling in, as the volume is increasing. And sometimes I do end up adding back too high, and I get burned a little bit on the last trade, which is why it's also important as part of the management of the position that as you build profit, you start to reduce risk. As a more experienced trader, there will be times where you make the executive decision that as you're building profit, that you're going to increase risk because the market calls for it, because there's incredible opportunity. And on days like that, you may be able to do very well, but you still would carry the risk that in one trade, you could ruin your entire day. You could give back everything you've made. And I say that having done it. So the risk factors of the first pullback setup. This is, in my opinion, one of the lower risk gap and go setups. Not to say that it's low risk, but it's lower of the setups that we look at because the stops are tight. These flag patterns are typically very strong. They're so obvious. Almost anyone can see it, especially when it corresponds with a 5-minute and a 1-minute. Multi-time frame alignment will only make it stronger. If it's a first pullback on the 1-minute and it is already extended on the 5-minute, you may not see the same level of follow through, but they're still usually going to be pretty clean. Now, additional risks certainly are a secondary offering coming out. This is going to be a common risk of any gap and go trade. We can check for active shelf registrations, but of course, many stocks have them and don't do secondary offerings, so it doesn't really guarantee anything. A company can also file a shelf registration on the same day, and that would have a negative impact as it puts traders on notice that the offering is coming. The stop loss on this. So in terms of thinking about, it's one thing to focus on, the profit target and how much we could make and how much this maybe could go up. But what are we really risking? The stop should be the low of the last 5-minute candle if you're trading this on a 5-minute time frame, or the low of the last 1-minute candle if you're using a 1-minute time frame. If you're using the 10-second chart or a 30-second chart or something like that, you could use the low of the recent pullback, but typically that's going to correspond to the last 1-minute pullback. You can also use arbitrary stops of like 5, 10, 20 cents. The only problem with using an arbitrary stop is that sometimes it's hard to enforce it when it dips down and you're like, well, it still looks strong because it hasn't hit the technical place where if it breaks that level, it's weak. So arbitrary stops can be a little hard to enforce. Typically, I'm going to use the breakout or bailout sort of approach rather than identify an exact to the penny exit. So if we pull up, we'll just pull up this chart here on AUZI. So on this current chart, I would say we clearly have a little bit of an ABCD pattern happening on the 1-minute. The 5-minute is a red topping tail, so that's an unattractive candle. But if this broke over 32.89, that would be bullish. We would then look for a retest of the high of day, which is up here at 35.41. And the proper stop, is down here around 29. In fact, it's a little bit lower, down at 28.71. That's the proper stop. Now, probably not going to want to buy this with a 4-point stop. So in a case like this, we may say we're going to have to use an arbitrary stop. And maybe right now, this pattern is just not clean enough that we could trust an entry at 32.89 until perhaps it's consolidated a little longer. In this type of situation, we could consider a dip trade long with a stop at 28.71, which is the double bottom, but that's a more complex setup that we're not going to talk about too much right now. So generally speaking, we look at the pattern and what's the recent low, and if it's just really far away, kind of in the case of that one, then we're probably going to have to be a little bit more cautious. And if it's, if it's a little bit closer, then that's going to be fine. Sometimes people will say, Ross, what's your stop on a trade? And sometimes I'm trading so quickly that I don't always have a direct answer to that because it's like, well, I'm buying the first candle to make a new high. Obviously, my stop is the recent low. I may not know exactly what that is, but I know when the chart doesn't look good anymore. So the only problem is in a case like this, that's 4 points away. So it is a good idea not to get too caught up in your trades that you forget about your risk management, because obviously we do have risk in any trade we take. But generally, just because I know the technical stop in that case was 28.71 doesn't mean I want to hold all the way down to it. I'd rather just cut the loss and then get back in if it looks better. So if the stock doesn't break out immediately and do what I think it's going to do, I can get right back out. But then if it comes right back to that level, then, and this actually just broke 28.71 is now coming right back up. Then you're like, gosh, darn it. What do I do now? Am I the guy that just got stopped out at 28 and now I get back in at 30? I can't do that. and you start feeling like you're getting chopped up. And so when that's the case, that's usually when I would say, listen, guys, I'm just going to try to be a little objective here and say this stock is pretty choppy. Maybe this is not the easiest one to trade. And maybe I've got to wait for, better opportunities somewhere else. Because getting in, then getting out, then getting right back in, then getting out, then getting right back in, getting out, that starts to get annoying pretty quick. So this is an example that I've probably shown you already. I think I showed this in the starter class. First candle to make a new high right down here, and again right here. So our first candles to make a new high, excuse me, pretty clear, pretty obvious setup there. Proper stop is at the low of the last pullback right down here. Proper stop, low of the last pullback. Here's another one. So in this case, you had to squeeze up, break of the pre-market high, which is a different strategy that we'll talk about. So this is actually a pre-market pivot at 260. Break of the pre-market pivot would have been along at 260. That's a strategy we'll talk about in chapter 7. But the first candle to make a new high is right down here. That's the entry. Stop is at the low, and there you got a nice curl back up. But then you get this sort of starting to pull back and just surging higher. Starting to pull back, then surging higher. Starting to pull back, kind of a pullback and surges higher. And when we get that kind of action, then into a little bit of an ABCD pattern here, this type of action here is where I would start to sometimes say that it's a grinding stock. And that grinding price action, that grinding kind of action can be difficult to trade through. Andrea, a question there about wash sales. So we're going to talk about wash sales when we get into the chapter on taxes. You are right that if you get in and get right back out, get right back in, get right back out, you could have an issue with wash sales, but that is a could because it depends on several different factors. First and foremost, are you trading in a retirement account? Because if you are, there's no wash sales because there's no tax. If you're trading in a regular account, you can be exempt from wash sales if it's just a day trading account. There's some paperwork you have to file related to that. And I would also say that wash sales, while they are, while that can be an issue, that it exempts the loss because you bought right back, in practice, when I've actually looked at an account that was subject to wash sales, I really didn't have that many, even though I did a lot of that type of trading. So it's not a huge concern for me, but we'll talk about that more as we get into it. So for right now, let's not worry about it, just from the perspective that the strategy, we don't really trade to mitigate taxes, so to speak. You certainly could if that was enough of a focus, but that again is kind of like skipping over pennies to save dollars, or skipping over dollars to save pennies. It just doesn't, to me, really make sense, at least if that's the focus right now. But it's a good question, and it's something good to be mindful of. Yeah, so anyways, nothing really to look at there. Okay, so here's, this is a first pullback after a red to green setup. So the red to green setup, we're going to talk about that. That's another specific setup in chapter 7, but it's not my favorite because it's a little riskier. The fact that it goes red is inherently showing that early sign of weakness. So I like to start with my favorite, which is the first pullback, and that is right here. That first pullback is right there around 250. Pops up, pullback right there at 250. So if you see that, that is the first pullback. That's the entry. And that gives us a nice rip from $2.50 up to $3. That's fantastic. I mean, really, that's an awesome trade. That's a 25% winner, and just like that. Here's another first pullback. This was SIF. So this one I showed you when we did our the intro to chapter 7. So consolidation, break of the pre-market high, which was 440. It rips up here. It pulls back, first candle to make a new high. Boom. That's the entry. And that gives you a nice, almost instant breakout and a move higher. And that's what you look for, nearly instantaneous resolution. That means you're not the only person that saw that setup. And so again, a big part of trading is kind of knowing what the crowd is trading. And the best way to kind of think we know what the crowd is trading is it's a leading stock in the market. It's one of the leading gappers, and it has high relative volume. That's kind of all we can do. You could subscribe to every different Reddit stock trading community. You could try to subscribe to every different, free and also premium chat room that's out there. You could try to subscribe to every alert from, Jim Cramer and all the other, big traders out there that put out alerts, every Twitter feed. But that's going to be a lot of stuff. That's going to be a lot of money. So let's just focus on sort of what all of that has the effect on in a stock is rate of change, high relative volume. So if we have the rate of change, we have the high relative volume. I guess it doesn't really matter, where it's all coming from. Is it on Reddit, that the community on Reddit is all into this particular stock? I have really no idea why AUVI, for instance, is up as much as it is today. I mean, we have news on it, but this is up like 500%. So, but the fact is, it doesn't really matter. We've got the high relative volume. Traders are watching it. And the place that I would say most traders would be watching right now would be right around 31.50. High of this current candle is 31.50 on the 5-minute. You have the red flag of 2 red topping tail candles, shooting stars. That's a red flag for sure. Highest volume of that move was on a red candle. But this is the level. That's the line in the sand. And so if that breaks 31.50, we should expect some type of resolution. So just as an example of it, why don't we pull it up in the simulator and just see if it comes up to that level. So we know 31.50 is our line in the sand. So we put the order at 31.50, but we could do an offset, maybe 31.55. Now this could be the type of stock that we would want to say, and if this was a gap and go setup and this was the first pullback, we could just pretend that this is the first pullback here and it's 9:45 or whatever, or it's pre-market. The pattern is still the same. The resolution might not be as clean on this at this time of day, but the pattern is still what it is. So 31.50 is our logical spot. Now the stop, what's the low? Well, it's down there at 28 bucks. So that's, $3 away, $3 a share away. That's a good distance away from the current price. So, and then on the 10-second chart, if we tried to zoom in a little bit more, what we're really seeing there is a lot of choppiness. But I would still think that most traders would have their eye on that 31.50 spot. So it's possible if we saw this curl up to 31, we could maybe consider a starter over 31 and add at 31.32 and then add at 31.50. That way, by the time it breaks through 31.50, we're not taking our first position. We've already accumulated a little bit of a starter. I got those lines based on the 1-minute, 10-second chart here at 31 and 31.32 and then 31.50. So we may use that 10-second chart to help us get a little bit more dialed in about a potential entry as we start kind of, hunting down for where can I actually get in this thing. This does have the support of the 9 moving average below it, which we know we like for most pullback setups. It's a 5-minute pullback. The 1-minute, of course, is not quite as clean. Usually, a lot of the trades we'll take will be on the 1-minute chart. Because the stocks are moving so quickly, they don't wait for that first 5-minute candle to make a new high. They just they just rip. They just start to really open up, which this one certainly has. So it seems like it's stalling out a little bit here, so it doesn't look like we'll get that live example. That's okay. So here's another one. First 1-minute pullback. Okay, so in this case here, breaks out pre-market at the open, squeezes up, halts going up, opens higher, drops down. First 1-minute candle to make a new high is right here. Little caution here with that big red volume, that big red candle, but stop is at the low, $3. It rips right back up, and then second pullback right there. This is the second pullback. If that's the first one, this is the second one right here. It pops up, it drops down, and in a case like this, it's possible that, remember, because this broke, first 1-minute candle, it actually squeezed right up to the top, up to 444. It broke the high. That's profit target. Probably would have sold at least half, maybe more. It drops back down. Maybe I sell the rest, break even. Curls back up. I might get back in right here. It's showing strength. I'm back in. Maybe add for the break through the highs and then look for that squeeze up to there, 550. Pulls back. First 1-minute candle to make a new high right here in a much larger range, but it's still working. It's still looking good. Then it tops out here a little over 6. All things considered, that's not too bad. I mean, that's really what we like to see. This is the example of ACB. It opens low because of a market order at the open. Then it surges up, clear 1-minute pullback right here, and it's right under the whole dollar of 15. Now let's look at this one here. That just broke like that. It was so fast. When they break like that, the high is 33. And then what I'll do is I'll say, let's look at the first pullback. So then I add the first 10-second pullback there, micro pullback for the break of 33. Now that was actually kind of funny because it hit a high of 33.10 and then dipped right back down. But typically the first micro pullback after a fresh break gets bought up at the right time of day on a gap and go stock. So we'll see whether or not this does. The high of this current 1-minute candle is 33.10. We know the correct entry there was 31.50, and if you took that entry, you were up over $1 a share, boom, instantaneously. Now the high of that candle is 33.26. So it kind of topped out there and pulled back, Our 10-second chart is showing that this is a little choppy. Golly, now down here at, well, 30, look at how wild this one is. So is it going to break 33.50? That's psychological resistance, the $0.50. And it feels like this one's having a little bit of a tough time. And now it's coming back down, and this is where you say, well, uh-oh, if it drops, how much is it going to drop? I'm in at 33. If it breaks 32, that's $1 a share. In a situation like this, I might put an order at 33 to try to get out break even. Let it pop back up. Let's see if it pulls me out break even. Now, I changed the bias from this could be a winner to risk management. Minimize the damage. I'm seeing some red on the tape there. I go to 500 shares and put a new order at, let's say, 77. If it pops up to 77, and just like that, it's going lower, and I'll have to cut the loss. Sometimes like this, is it going to pop right back up? You can see on the 1-minute chart a double top pretty close there at the high. We've got the double top right there. The 10-second, 2 topping tail candles. And look at that. It dips down, then right back up. So in a case like this, I'm going to put the order, and I'm going to be grateful to get out break even. I changed the bias. The bias changes from this could be a big winner to this is a choppy stock. I almost just got smoked. Okay, now it's at 33.60. Fine. But I can't get back in up here. I can't possibly get back in up here. The first 1-minute candle to make a new high, in this case, the first pullback, yes, it was at 33.50, but that was a double top here. See that double top, 33.36, 33.40? That's a risky place to be a buyer. It tops out at 35, and then look at that flush back to 33. Now we're starting to worry about possible double top risk versus the high a day, which is 35.41. So you'll find that some stocks, and now you've got topping tail doji. So all of this analysis that's happening in real time, it's a combination of 10-second, 1-minute, 5-minute charts, level 2, time and sales, seeing those big bids, seeing the spreads, and recognizing in this particular instance that I may not feel that I have a good edge on this stock. Where am I going to get in? The spreads are so big. It's so choppy. Do I get back in here for the breakthrough 35? The problem is, if I did that, and let's just watch, look at how big the spreads are. So back in there at 35, that's a high day entry. That's a chase. Now, in this case, is it working? Well, it worked for a second. The high was 35.73, but now it's back to 34.50 on the bid. And it broke through the highs, 36. Is it going to break or is it going to reject? So this is where, you start to feel like you've got this big spread here, 50 cents. This is going to be a stock where we would just say, like the idea, and look at that, back down to 33. I'm down $1,300. This would be one where you say, I like the idea, but the fact is, I can't manage risk on it. It is just too choppy. And sometimes a stock can go from, first 5-minute candle, 31, all the way up. And you just, the best entry here, though, was this first 5-minute candle to make a new high. And then the 1-minute pullback on this, maybe it's the time of day issue, but it was just too choppy. So I think that's a good reminder there about the importance of using the 5-minute chart. 5-minute charts are a very strong time frame. This is a clear double top here. While it may create that cup formation, which is this is the cup and then the handle, but whoa, look at that. Are you kidding me? That just dropped 3 points, 2 points in one candle. 3 points from 34 to 31. Now there's panic. Now panic sets in. People are scared. 29.84 halt going down. Just like that. Right? So, and this is not all to say that you need 10-second charts. I just thought I would show you them here. It depends on how quickly and how aggressive you're trying to trade. The 1-minute chart was clear as can be at 31.50. The 10-second provided a little more clarity, I suppose, but the 1 minute was fine. It really was fine. So there's a nice pullback. Here's another one here. First pullback is right there. So it rips up, breaks the pre-market high, pulls back. What do you notice here at 8 a.m.? Institutional trading orders going through. Choppiness. First pullback, that's a clean one. Okay, so where's the entry? The entry is $4.36. How would we have found the stock? It would have been on our gap scanner because it's a gapper. Then as it's squeezing up, it would have been on our momentum scanner. So usually what I'll be doing is I'll have the momentum scanner, of course, right here, showing me stocks that are squeezing up right now. Once the bell rings, I don't really need the gap scanner anymore unless I just wanted to stay familiar with the gappers. And so the way I have my my platform set up just to kind of give you guys the little behind the scenes. So this is how I have it set up. I've got my, my trading screen right here. So this is my trading screen right here. Up here, I've got my this is usually 2 charts. So I have, this is one stock on the left, 10-second, 1 minute, 5 minute, daily. This is the other stock on the right here, sorry. 10-second, 1 minute, 5 minute, daily. Over here, same thing, 2 stocks, 10-second, 1 minute, 5 minute, daily. 10-second, 1 minute, 5 minute, daily. Up here is extra space right now where I'm keeping, I could put charts up there, but I really only, this is what I use. And then this is the screen that's broadcasting, usually to the chat room, which has my scanners on the side and this chart right here. Now, when I'm traveling, those of you who have seen my traveling trading station is laptop and 1 external USB monitor to the left and 1 to the right. So I have 3 monitors, which means I have this window, I have this window, and I have this window. And these ones are gone. So on days where I'm traveling, I'm really focusing on 2 stocks, and then maybe 3, the one that's on focus up here. And yeah, this is a Falcon laptop. It's thick. It's a heavy laptop. But it's good. I mean, I like it. It's a good laptop. So anyways, but that just gives you a little bit of the sort of what I'm looking at. So we would find a stock because it's on our gap scanner. We would see it ripping up likely on the momentum scanner. When we see a stock on the momentum scanner like AUVI that we already know, then we probably already have the chart up on it. So I am actively watching usually 1, 2, maybe 3 stocks at the same time. I don't usually have 4 stocks that I'm watching. I mean, I might have 4 stocks that are up here. I might have, AUVI and CHCI and, the HTBX. So I'm just looking at the gappers from today, CHCI, HTBX, AUVI. But, I usually, today I had CHCI, I had HTBX here on this one, because those were the 2 I was trading to start the day. I was focused on those 2. And then I had AUVI over here on the side. And I think I had something from yesterday still sitting on this one. But generally speaking, I have, the 2 stocks I'm kind of most focused on, the 2 leading gappers. I have my level 2 windows for each of those 2 stocks, left and right, HTBX, these 2. And so when I start to see, if I see the stock hitting my scanner, which in the case of this example right here, we would have seen it hitting the scanner as it made new highs right there. Now we have to have the discipline to wait for the pullback, but we don't have to wait very long. A 1-minute pullback would be fine if it's really strong, or a 5-minute pullback is okay too. So here we have the 5-minute pullback. Down to the low here, bouncing right off the 9 moving average, very close to the VWAP. The entry is 436. Max loss is 421. 1,000 shares, you're risking 150 bucks. Your profit target, roughly 30 cents. So, 46, 56, 66 would be nice. It rips through here the $0.50. It breaks through the high and it surges up to 5. You can see right here, because of that topping tail and because of this candle, we know that did a micro pullback. So that did a micro pullback right there. That could have given us an entry at 510. You'll hear me often talk about if it breaks over 5 and holds that level, I want to buy at 510 to 515, stop is 5. If it breaks over 550 and holds, I'm going to be a buyer around 565, 570 for the move up to the next whole dollar. We know stocks trade in these levels of $0.50 and whole dollars. And so as we see them trading above it and holding above it, then that can provide that entry for the next leg up, moving the mental stop higher. And again, this one went from 436 all the way to 650. I guarantee you that on the 1-minute chart, there were multiple entry opportunities. REXN. Okay, so we've got it's a gap and go stock. Now, if it was one of the top 2 or 3 gappers, we would have been watching it very closely. It goes a little red at the open and it does a red to green move. We'll talk about that in chapter 7 under its own setup. But as it breaks through VWAP and pulls back, it gives us our first pullback setup here at about 260. Stop down here just below the low of this candle, which is about, looks like 15 cents or so, roughly. Target then about 30 cents, so 290. It rips up, taps, looks like about 315. Pulls back, then it rips through that level. That would be an opportunity to add a little bit back. So let's answer the question there about position sizing. Okay, so generally on these, position size is relative to risk. The position size that I take is certainly going to be different from the position size that you would likely take, just based on experience. And that's probably, you understand that. But what I would typically do right now, I would say, I mean, today is a little, this last week has been a little choppy for me, but 2 weeks ago, I would say that my full size on a trade like this might be 50,000 shares, 50,000 shares. So my starter would probably be 9,000 shares, and I would probably execute that in 3 orders of 3,000 shares. So my order entry window here is, I have it defaulted at 3,000. I previously had it at 2,500, and then I increased it to 3,000. Sometimes I think about increasing, I actually did increase it to 5,000 at one point, and then I had to bring it back down because I was being too aggressive. 4 clicks and I'm in with 20,000 shares. So at 3,000, usually what I would do, ZVZT, is I see it starting to rip up and I click the buy button once, and I see the green go through the tape. And if I'm seeing the confirmation of that I'm not seeing a hidden seller, right, that it's actually moving up, then okay, I'll press it again. If I see a hidden seller, I stop right away. I'll say, no, I'm not adding any more. No hidden seller? Okay, now I'm in with 9,000 shares. That's 3 clicks. Yes, that's 3 commissions. At light speed, that costs you $6. $2 a commission times 3. It's no big deal. All right, so $6. So I'm in with 9,000 shares, and that might be right here at about 265. It squeezes up to 280. I might consider adding through the high if it looks like it's moving very quickly. If it's a thinner level 2 and you can see how rapidly it's moving up, if it's approaching a halt level, and I think it might get halted going up. If it's a more just kind of regular stock or it's a little slower moving, then as we come up to those levels, I might go ahead and throw half on the ask, another half on the ask, and sell the rest maybe at break even or hold a smaller position. Now it taps 310, pulls back. I might add back 6,000 shares for the break of 310, going back up to full size, which in this case right now is 9,000 shares. Just in this instance, it's 9,000. If I was going to go to like 50,000, I would probably be starting with 15,000, 9 to 15,000 shares and going pretty quickly up to 25,000. And so the thing with scaling in with that size is that I keep adding higher. So I usually need something moving up pretty quickly to keep adding higher and higher and higher. But anyway, so then I'll take a little off and then I'll add back. But the thing I have to be careful of is that, up here on this dip, that I don't add back to a full 50,000 share position with a cost basis at 4 and then get caught in one of those drops, or one of the drops that we just saw in the case of AUVI. So as it's going higher, if my initial position down here might have been 50,000 shares, then as it's going higher, I take some profit off the table and then I start adding back smaller size. So maybe that would be 15,000 share, buying 15,000 shares on the dip, selling with 20 cents, that's $3,000. Doing a few trades like that with what in that case would be about 1/3 of my full size. Because as it gets higher and higher, we know that they get top heavy, and then the potential risk of that quick flash drop, all of a sudden you could have one trade that knocks out everything you just made. And you don't want that to happen. So that's where we have to start sizing down as they get higher and higher and higher. This is a great example of a 5-minute bull flag. Nice ramp up, no doubt, providing, you can see here at 4, a tap, a pullback. Definitely that was a 1-minute opportunity, and then a rip higher to 420, a pullback, then a rip higher to 440, a little pullback, then a squeeze up to 5, topping tail, pulls back, holds that level, first candle to make a new high, breaks through 5, another topping tail drops down, then it surges higher. This is the type of setup where when it breaks these highs, to me, that's just squeezing out short sellers because it's not really a safe long because of the topping tail. But it's going higher, obviously, so let's just ride the momentum. And it goes higher there up to 560 and 570. In the live trading archives, you'll see more examples of hidden sellers. So we'll get into that a little bit more, and I have some live examples of this setup as well. All right, so squeeze there up to 2. So this is what we would call the pre-market pivot, which is that it hit a high, pulled back, kind of hit this level, pulled back. And so kind of like in chapter 4, how we look for gaps in windows, I'd sort of look at this as left and up. So the high there of 227 to the left and up, the next level is 240. Now, one thing I would say about the topping tails is that You're right that sometimes we'll see a topping tail and then the stock goes higher. And you're thinking, gosh, what's a topping tail supposed to be a candle of indecision? This thing doesn't seem to care about them at all. And sometimes they don't. Sometimes short sellers get squeezed out and you've got someone out there that's buying up shares and they just, I don't know, they just go higher. You're right. And so when stocks do something that's kind of counter to what you would expect, to what's logical, that's usually when traders start to get kind of squeezed. So in the case of a short seller, this shouldn't be going up. It has two topping tails. Why is it going up? That's where some stubbornness can start to come in. I'm not covering this. I'm going to add more. And then it starts going higher and higher and higher. And then finally capitulation. It doesn't make sense, but I'm just going to get out. That's what we saw in GameStop. And likewise, sometimes when a stock drops, why is this dropping? It's breaking through support. Everything looked good. It doesn't make sense. But it drops more and more and more and more. So focusing on the technicals and trying not to get too much of a confirmation bias and getting stubborn is important. So we have a micro pullback here on the 1 minute at 227. Now this would have been valid, especially because of this little top here. So it taps, pulls back. That would have been a nice entry. Then it rips up to 260, pulls back. First 1 minute candle here, that's a bull trap. It comes down, stops us out, and we're out. So if we took that trade, it would have been a loser. And that bounces off the VWAP. Then it rips back up here and all of a sudden surges back through the high. And then it kind of just grinds higher, pulls back, and then that 1 minute pullback provides a little bit of a safer entry for a squeeze up to 3. It breaks over 3 and comes back below it. So as we look at that pattern, we could, I think, say this stock looks choppier. This is a choppier stock, and some are. Nothing we could do about it. Some are choppier than others. And if a stock is behaving in that way, or kind of in what we're seeing with AUVI, this just may not be the one to focus on. While, yeah, someone else with a different strategy maybe made $150,000 on it, for me, for my strategy, it was kind of hard. It was choppy. So I'm just going to let it be what it is. I'll come back tomorrow and look for something better. Now, this is a first pullback here that also is a bit of an ABCD setup, which and we'll talk about, again, we have specific examples of that, but a squeeze up here, first 1 minute candle right there, nice, rips up into the market open. So if you held this into the open, it would have worked, and right at the open, it surges up, whips down, very common, bounces back up, pulls back, break through that level is sort of that pivot. We break through that level, next target is the high. This is an okay setup here. I would have been fine with this. And you get that squeeze higher there from 4 up to 5, but then a big red candle. So it really rejects that level. But again, if we focus not on these, micro 10-second patterns up here, but we focus on the clean 1 minute patterns or the clean 5 minute patterns. Maybe we use the 10-second chart as that pattern is forming to give us extra confidence, but we first want the strong 5 minute, the strong 1 minute, and then let's take our entries. This is BPTH, just kept pulling back and going higher. Pull back, pull back, pull back. It just kept going higher. So each of these pullbacks just kept working really well on the 5 minute chart. On the 1 minute, this one was a little choppier. And sometimes, sometimes it's like that for whatever reason. We don't always know why, but some stocks are just much, much cleaner on the 5 minute than on the 1 minute. 1 minute chart here, squeezes up, pulls back, and then right at the open just rips right back up high. So kind of tricky probably at the open, but first pullback right there, new entry. So pullback entry, and then that gives you a rip from 270 up to 330. It does reject off that level. But your entry's here, so 9,000 shares, let's say, selling half as it starts to approach $3, which is psychological resistance. Maybe considering adding back over 310 and then selling all of it at 315, 320, or scaling out and then selling the rest as it comes back down at 3. Here's an example, MDRR from $2 to 6, rips up, micro pullback, rips into a halt, opens high, dips down and back over 3. Rips up here, pulls back, first candle to make a new high right there, gives you the rip up to 4. First candle to make a new high, rip now up to 5, into a halt, opens, squeezes higher, then rejects. Looking for the first candle to make a new high. Right here, a little pullback, pop up, first candle to make a new high, a little choppy, not easy, squeezes into a halt, opens high, pulls back, first candle to make a new high, rips back up here to $5. So let's look at a couple of examples here. Let's see. I'm gonna close this. Where is my? I'm going to open this again here. Presenter view. There we go. All right. Okay, so let's see, what do we have here? Okay, so this is XRF. So on this one right here, the high of the last 5-minute candle is just over 550, that red candle. And so technically the first candle to make a new high is going to be right around 250 and 255, right around there. So 255 with a high of day of 259. Orders at 250, and I've bought to anticipate the break through the $0.50. Oh, let me move the camera. Thank you. Okay, so I bought to anticipate the first candle to make a new high and the break through the $0.50 as it starts to surge up. Our high is 259. We have a seller here of 40,000 shares at 50. A lot of volume, 13 million shares of volume. It dips down. Oftentimes, the first time we tap that psychological resistance of a half and whole dollar, it's very common to see it tap it, not break it, pull back, and then on the second attempt, break it. Sometimes the second attempt fails again. It pulls back, third attempt breaks. So right there, I added, as you can see, cost basis, 248. So I was adding at 250 for the break through that whole dollar, or $0.50. Now I'm holding. Alternatively, I could have sold. It hits 250, 245, but on this one, I'm holding strong. This might have been likely the leading gapper, which gave me the confidence that the pullbacks will get bought up and it will go higher. So certain times of day, earlier in the day, I will be a little bit more aggressive. And I certainly was on this one to not just sell, but to hold through this move. And in fact, I'm going to look for a place to add to the position. So the high of this candle, if you notice there with my mouse, I put my mouse on this candle. So this window right here would show me the high and the low of that green candle. So right now my mouse is on this window. I'll just go back here. It must have been. All right, so we'll just go back. Why don't we just watch the break again? So we'll see that quick snap. But again, it's very common to see a stock approach a $0.50, tap it, and fade. Come back up for a second try, tap it, can't do it. Come back up for the third try, rips through it. So just because it fails the first try doesn't necessarily mean I'm going to bail out. Depends on the time of day, my cushion on the day, and a few other factors, but you can bail out and then get right back in, but you can also hold and give it a chance. So here, bringing my mouse right over there. See, my mouse is on that candle, telling me the high is 270. So I like to see the high of that candle. So on light speed or e-signal here, my cursor highlights the specific candle, and then this window right here, this box, tells me some information about that candle. The open, the close, the high, the low, the volume weight average price at the time, today's open, the moving averages. And I don't need all of that information, but that's just all that it shows me. So I'll often do that and just drag over really quick. There's a couple different settings that you can change. But anyways, we'll just for right now, we'll skip over that. Okay, so let's watch this. There's 255. 257. So I'm looking for the break of 270. 268, 270, 268, 269. Can we get the break of 270? 270 on the ask. There we go, 273, 274. Now I'm really in the driver's seat. I'm actually going in here. My max size on the day I had set at 12,000 shares, and I'm increasing it so I can trade with larger size. So this may have been a day where I was trying to kind of press the reset button after a couple of red days. I don't know. I don't remember, but that's what I would imagine if I had my share size that small. So Daryl's question there, Danny. I saw Cheryl and Danny, and so I just said Daryl. So Danny's question, or Daryl, if we just combine you both into one person, is, Ross, you're holding that full 10,000 share position. Do you typically sell with the break or wait to sell. I guess it depends on the level 2 action. And yes, no, you're right, absolutely. Daryl, you've got it perfectly there, that in some cases with bigger size, I might have taken all of this off the table and then added back maybe at 70. In this particular case, this is kind of an example of me playing it a little cool. You know, I'm kind of like, yeah, I like you, stock, but I'm not crazy about you. I could take it or leave it. I took my position and I'm just sitting back and letting it work. This would be the example of kind of the slower moving type of trade, which is fine. It's not as fast and maybe as aggressive, but it works. And in this case, $1,500 of profit is not bad. I have my hand on the buy button right here and my order's at 82. Now, this video, I'm pretty sure I end up ending here, but I add back at 70, and I'm pretty sure this ends up going up just shy of $3. So not bad. All right, so that is the sort of clearest example that I have specific to that one. In our in a couple of our examples, when I get into breakout trading, you're going to see more instances. And also, that was a very specific example of right at the open. In Chapter 8, we're going to have the first pullback, which is the same setup in Chapter 8, except we're applying it to kind of any stock that has momentum, even if it wasn't a gapper. So Chapter 7 is just stocks that were gapping up. Chapter 8 is all momentum. Sometimes it's a gapper, sometimes it's not. So there's some more examples in Chapter 8 of the first pullback that if you guys are really wanting to see more examples, you could jump forward to that. You can also see more examples in the live trading archives and more examples in Chapter 11, which is high-speed breakout trading. And with that, as you may notice, it's snowing out here, and I'm going to take my oldest son skiing. So we're going to call it a day here, and we will pick back up tomorrow with Chapter 7, Part 2, or Setup 2, which, let's see, is the break of the pre-market highs. All right, so I hope you guys have a great rest of the day. Those of you watching in the Learning Management software, feel free to continue on, and I will see you in the next class, Chapter 7, Part 2, Setup 2.